Fala, galerinha, muito bom dia, boa tarde, boa noite. Estamos na Expert XP 2025, aniversariando 15 anos. E essa Expert está sendo super especial, dinâmica. E eu tenho um orgulho aqui de trazer uma pessoa que eu sou um fã de carteirinha. E essa Expert está sendo especial e a gente quer presentear você com essa personalidade que está aqui comigo, no qual eu já vou introduzir a vocês e dizer que é um motivo de muita alegria poder fazer esse podcast aqui e presentear esse evento maravilhoso. So, let's talk about him. This is John Bollinger. John holds CFA and CMT designations. He is the president and founder of the Bollinger Bands Capital Management, which provide technical-driven management service, and he developed proprietary research for institutions and individuals. He is the best known for Bollinger Bands, developed in early 80s, I think it's 80s, used worldwide by everybody. Its own most market chart software, including here, at the battle, we see a lot of charts with the Bollinger Bands.
We do.
Yeah. His book, Bollinger Bands, translated into 12 languages. He has these very prestigious awards, like the Technical Security Analysts Association of San Francisco Lifetime Awards. This is incredible. What achievement. He also achieved 2005 awards of CMT Association to the field of technical analysis and IFTA in 2015 Lifetime Achievement Awards. Basic, we are in front of the legend John Bollinger. He is here with his lovely wife, Dorrit, his daughter Zoe, which is now working with John's firm. We are about to talk about it. So, John, thank you very much for coming. So this is incredible. So my first question is, what is your first impressions of Expert? What did you feel when you came in here and look at this crowd and the people here?
Well, first of all, thank you for inviting me. It's a great pleasure to be here. And this is clearly the biggest show that I've ever seen. I've been to many shows around the world, China, all throughout Europe, all over America, such, Australia, the rest of the world. And this is by far and away the biggest show I've ever seen.
Wow.
More people, more booths, more companies, more buzz. Yeah.
Yeah,
it's really an incredible show.
This is XP. This is XP. Yeah, nice. So, John, let me begin to start off with what did you do before Bollinger Bands, before the markets?
So I started out in the movie business. I was a cameraman in the movie business.
Wow.
I went to school for a couple of years to learn camera work and such like that, and then apprenticed to a very, very skilled cameraman by the name of David Quaid. And that's how I learned my trade, working as his assistant. And eventually, that was all in New York, and eventually the call of that work and such got me to move to California, because more of the type of work that I wanted to do was there. So that was my first career.
Nice.
Took me up to about age 30 or so.
Wow, amazing. So you were at New York, isn't it?
Yeah, I was raised in New York, right in the city, the west side of the city, and I left when I was 26 or so.
Oh, great.
Happily lived in California ever since.
Wow, that's amazing. So how did you get in this business? Now we are talking about stock markets. What is your first?
I'd always been interested in stocks from a very young age. My grandfather gifted me some stock when I was 7, 8, something like that. and I'd always tracked the stock market. My mother was getting ready to retire. She had a advertising agency that she'd built up, and she was getting really poor financial advice, which she recognized. She asked me if I could help her with her retirement because she knew I liked this stock thing. So I said I'd give it a try, and I started the classical way, taking brokerage research reports and fundamental analysis and such like that. And I had a really, really hard time. I just wasn't making any progress whatsoever. And then, I started to get interested in technical analysis. I was an early adopter of, we called them microcomputers at the time. It was before the era of PCs.
Mm-hmm.
And I started reading technical analysis, and I looked over at the computer and I said, well, this computer ought to help me do technical analysis. And that was really the final hook.
Wow.
After I started working on that, I got involved in finance full time and have been ever since.
Nice. Yeah. I see some similar things with my life because my father, which is retirement, they asked me to, rule and try to figure out the best money management for him, which is investment and things. So, yeah, it's remember my father's the same way. Remember my father asking me for help and say, "Oh, I'm about to retire, so would you take care of my money?"
But my mom lived long after she retired and passed on with the same amount of capital that she had when she retired. So
great. So you did a great job.
Yeah,
definitely.
Yeah.
So,
and that's all technical analysis and with some help from fundamental analysis, but primarily technical analysis.
Yes, I would like to touch on that because you are a CFA. So you started with fundamental first, and then you became technical. How is that combined?
I tried the fundamentals first, but I really became a technician. I mean, that was my calling. And after I had been working in finance for about 4 years, I realized that I needed a broader base. I needed a greater knowledge, and there were many areas of finance that I just didn't know anything about because I hadn't taken it in college or anything like this. I hadn't been to business school or such. So I decided to sit for the CFA exams because they covered a tremendous broad base of knowledge, and that was an incredible experience for me. It took 3 years, and I worked for Beaver for about 6 months of each year, passed the exams. But what it taught me was a great deal about modern finance, about portfolio theory, about analysis of different kinds. So it provided a very strong base for my future growth. But yeah. I was before and remain primarily a market technician.
Yeah. People here in Brazil, we have a lot of CFAs here.
Yes,
and also CMTs. But and if you want to earn more money, probably you have to take both designations.
Yeah, so I was the first person ever to hold both designations.
Oh, really?
Yeah.
Wow.
And, it was just by default. It wasn't an accomplishment or anything like that. Of the 35 or 40 people who took the first CMT exam, I was the only one that had a CFA. So, yeah.
So what achievement. So
and today there's hundreds and hundreds and hundreds of people.
Yeah, there's a community.
Yeah, we call them dual credential holders, and there's
dual credential.
many of them.
Yeah. And I on my personal way of see the markets, I think when you get both CFA and CMTs, you feel more like ready and prepared for the markets.
It's a much broader base to base your operations on. It really provides some strength.
Yeah, and what I like most, especially on CMT, is this community because you can share your experience, your indicator, your the way that you see the markets and charting.
So after I'd been in finance for about 4 years, I went to work for the Financial News Network.
Really?
That was
Like a journalist, as you said on the
yeah, but my job was to provide technical analysis for the air.
Okay.
And as a result of that, my office was right next to the green room. That's where all the guests come in. So over the next 6 years that I worked there, I met everybody because they all came to FNN to do their presentations and such like that. So that was a tremendous opportunity, and that developed that, for me, that sense of community that you were talking about, because
Right.
I got to meet all these people personally and chat with them. As soon as they would come into the office, I'd steal away from my desk and go sit in the green room for a little while and try to learn something from them.
Nice.
And that was just an incredible, incredible opportunity. And it pointed to that deep sense of community that exists.
Yeah, I feel it. I can feel it with the CMT.
Yeah,
Every time that I go to New York or Washington or whatever it is. So we stand in a group, and we help each other. We share some experience with the markets and different cultures, like Indian, Chinese, Brazilians, and of course US.
Yeah, it's really wonderful. It's become a truly international.
Yeah. So, Joe, so how did you came up with the band? So what were you doing? So and of course, explain to us what is the band, Bollinger Bands, just to get the people know what are we talking about.
So Bollinger Bands are 3 lines that you plot on a graph with price. The middle band is an indication of the trend of price. The default is a 20-period moving average. And the upper band and lower band are set above and below that by a measure of volatility called standard deviation. And usually we use 2 standard deviations, though people use a wide variety of parameters. And what they do is they define high and low on a relative basis. When price is high, it's at the upper band. When price is low, it's at the lower band. And that may seem like a simple definition, and in a way it is, but it allows you to do tremendous things.
Yeah.
Right. So, for example, sometimes the market will make a bottom in the shape of a big capital letter W. You come down, you make a momentum low, bounce a little bit, make a final price low, and then you'll enter
the lower band.
Yeah, and you'll enter the the next phase of activity. Well, that first low is most often outside of the lower Bollinger Band, and that second low is most often inside the Bollinger Band. So you can just look for that setup, right? It's just a pattern that occurs in relation to the Bollinger Bands.
Mm-hmm.
And then a lot of people focus on how tight the bands are or how wide the bands are. And typically you'll see after you have a very strong trend, the bands will be very wide and they'll start to narrow, and that usually marks the end of the trend. Mm-hmm. So they provide a lot of information to the trader that they can use to make rational trading decisions rather than emotional trading decisions.
Definitely. Yeah, I totally agree. It's on my screen every day, every time. It's their screen. So how did you come up with this idea? So what were you doing? What were you thinking about? And how did you came up?
So I was an option trader at the time. And I was keeping, some option prices and volatility numbers in a very early spreadsheet. It was called SuperCalc, actually. And so back then we had a really great market timing tool. It was a very simple tool, but it worked very well. We took a 21-day moving average, and we made bands above and below it by a fixed width, 4.5%.
Okay.
So we had the 3 bands.
It's like a channel.
Yeah, like a channel,
okay.
4.5% channel, exactly.
Uh-huh.
And we plotted the Dow Jones Industrial Average on that. And then we took 2 indicators, one based on the number of stocks advancing and declining, and the other based on up and down volume. So if you tag the upper band with price, that is, the Dow was strong enough to get to the upper band, and one of those indicators was negative, that was a sell alert.
Okay.
And if you tag the lower band, price fell to the lower band, and one of those indicators was positive, that was a buy alert. And that was a terrific system. It was very helpful in those days. It had been broken for many years, but it was very helpful in those days. But the problem is that the bands were fixed width, right? And what we really needed was adaptive bands that would change with the different regimes in the market. So I was trying to figure out a way to automate the setting of the bandwidth. And one day I copied formula for volatility down a column, and I saw that it was changing dramatically with the price structure. And I thought maybe I could use volatility to set the width of the bands. And after a couple of days of experimentation and work, I came up with the basic formula for Bollinger Bands, which has remained unchanged for 40 years.
Yes. Yeah, so it's amazing. From my trade system, I have my own indicator, which is called
the Rafi
indicator.
Yeah.
And there is a situation that when we have a breakout, it's necessary. We have to expand the bands to get inside the trade.
Yeah.
And to follow the trade, to stick with your position, we must walk up with the bands. We must stick with the higher bands or the lower bands, depending on if you are long or short. But you must stick with the trade when the chart, or the price is very close to the upper or lower band, and you stick it together. And when it's got distanced, and in some way, you stop the trade.
Yeah.
So it's a very short-term trade system. It's about 68% of probability. A good sharp. I don't remember exactly, but we can adapt some ways in a long or short term, depending on the chart that you are using.
Yeah, I was about to say, I bet you if you switch to daily or weekly charts, you could have the same kind of results, but with a much longer term.
Oh, yeah, definitely. Yeah. So, and also, I mixed this indicator with ADX, directional movement.
Yeah.
Just to confirm that we have a strong trend for that position. So that's a little bit my system, one of my system that I use to make a short-term recommendation. So you came up with the bands, okay, you built the bands. And what was the idea of the book? Because you create something. The book was something that, okay, let's write a playbook here, something like this.
It was very simple. I wanted to stop answering the same questions over and over.
Yeah, the simple way to.
So I put down all the answers in the book. And the amazing thing about the book, it's now 25 years old, right? 24 years old. The amazing thing about the book is every 5 years ago, I go and I open it up and I reread it and I say, do I want to rewrite this or is it still good?
No, it's still good.
The answer is always yes. It's
I was about to ask you if there is a second or third edition.
No. I just, I wrote one book and I think that's enough.
So why? So I definitely see this is very special because it's unchanged ever since. So why is that from your perspective? Why is it still there? The people don't change the formula, the things. Why do you think it's untouchable?
I think it's very straightforward, actually. It's something we call first principles. If you just mentioned ADX, that's another indicator that's based on a first principle of market action. So ADX was developed near 50 years ago, right? And it works today more or less the same way it worked when it was originally written, and it's a very useful tool. And that's because it's based on a first principle of market action. Bollinger Bands are based on a first principle of market activity, et cetera, actually based on the combination of trend and volatility. So those indicators that have stood the test of time, like RSI, the Relative Strength Index, and stochastics and ADX, Bollinger Bands, many others. You can always tell which ones are based on first principles because 30 years later, people are still using them.
Still using, yeah.
They're still useful.
Yeah. I think that.
And you can tell. I do a lot on the history of technical analysis, and people have created many, 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 many indicators, and only a few stay with us.
Yes.
And the real definite difference, the real definition of success in terms of indicator building is based on first principles, and they'll last.
Yeah, definitely. And so.
But I must say that I didn't know that when I created it.
Okay.
I just did my best.
Yes, yeah, you definitely did. And so I would like to touch on that indicator, because the people who are watching us here, most of them are technicians, so they are studying technical analysis, indicators, trends, market breadth indicators, and etc. So in terms of indicators, do you see a lot of changing things? So do you see some indicators that doesn't work anymore? Like I don't see people working on pointing figure charts nowadays. It's a type of way. I don't see much here in Brazil.
So that's interesting. The classic example of an indicator that failed was the odd lot index, which worked perfectly for 30 years or so, and then literally one day just stopped working. It had to do with a structural change in the market. So the first principle that it was attached to no longer existed, and it broke.
Wow.
So point and figure's the opposite. Point and figure still works. It's just not popular at the moment. I have a couple of friends who are very, they use point and figure a lot, and they're very successful using it. So there's a difference between something that breaks and something that's just not in fashion these days. So point and figure clearly is not in fashion. People just don't understand. They don't understand it. But if they were to go and read a couple books on it, they'd find it could be quite useful. Unlike the odd lot index, which is simply broken.
Yeah.
And has never been useful since.
Yeah, because I'm asking you about this because when we get a couple of market breadth indicators, and we see S&P 500 right now, the top 10 leadership are the most weight of everything with fundamental earnings and, of course, price. So how do you see the market breadth touching on that? Because maybe it's, manipulated a little bit or not when we see a percentage of stocks above the 200-day moving average, for example. But the top 10 companies are below of the 200-day moving average. So we track the price down, but the market breadth has seen that we have 75% of the stocks are above the moving average. So how do you see these contracts between nowadays with these indicators?
So there's no question that the dynamics of market breadth have changed over time. And the indicators that the advanced decline line, up and down volume, the percent of stocks above and below a moving average, and the percent of stocks on point and figure buy signals versus those that are on point and figure sell signals. These are all market breadth indicators that can be very useful. Where they're most useful is when you find a real divergence between the price action of the major indices in America. This is like the Dow Jones Industrial Average, the S&P 500, the NASDAQ 100, such like that. When you see a big divergence that tells you that, 2 weeks ago, a month ago, something like that, everything was in gear, but now things have slipped out of gear. So that's a warning. That tells you to start to raise a defense. It doesn't tell you to sell or to short the market. You wait for price to tell you that. But we can use these breadth indicators as background indicators and use them as alert systems to know when we have to pay extra attention and be extra defensive so that our capital doesn't get taken away from us.
Yeah, nice. And it's, remember, I have this quote here that you said a video with Jeff Rich, a couple of days or a couple of weeks. I don't remember exactly when you recorded, but you said you have to learn what drives the indicators. And you said, quote, when you reach a market stream in which you are stressed to make a decision, you're going to look those indicators and you're going to know them. So you're going to be, these indicators, you're going to be your friend. So I would like to explain, what do you mean by that? So you must know what are you looking for, isn't it?
So most people just use indicators out of the box. They never look at how they're made or what they're looking at. And I think that's a big mistake. I think it's really important to learn, what drives the indicator, what the formula that it's based on is, so that you can know how it will behave in extreme circumstances. In normal circumstances, it's not that important, but in extreme circumstances where you have to make decisions under stress, you want to understand the indicators. And if you understand them, you'll know them and you can rely on them. Otherwise, you're going to look at them and go, I don't know what's going on here. These are behaving strangely. I need to, do whatever. And you'll make an emotional trading decision that will probably not be in your best interest. But if you really understand the indicator, then you'll look at the price, you'll look at the markets, you'll understand how the pieces are coming together, and you'll be able to make the correct decision.
Yeah.
So it's really important. I always recommend that people calculate an indicator by hand, either in a spreadsheet or on a piece of paper, doesn't matter, for a little while before they start using it, so they can really understand the mechanics of that indicator. It seems like a lot of work, but I think it'll pay off in the long run.
It's smart. Yeah, definitely. Yeah. So let's talk about the Bollinger Bands capital management. So you're running a firm. So how much money is in there for clients? So and what is your approach, your process to? Are you stock pickers? Do you combine fundamental with technical analysis? Which one do you use most in your decisions for your clients?
I founded Bollinger Capital Management in 1990 when GE bought F&N for the distribution and gave that distribution to CNBC. CNBC was based back in New Jersey at the time, and they offered me my job back there, but I didn't want to move back. So I decided to hang out my own shingle and start a capital management firm, which is really what I'd always wanted to do. And I've always based our operations on what I call rational analysis. So rational analysis is the juncture of the sets of fundamental analysis and technical analysis. So I like to say that, suppose you were in a garage working on a car and you got two toolboxes, one with red tools and one with yellow tools. Would you only use the red tools, or would you only use the yellow tools, or would you simply use whichever tool was right for the job regardless of what color it was? So that's how I like to think about it. So for instance, in a big input into our stock picking process, or a stock selection process, is earnings. earnings growth over
Okay.
time, consistent earnings growth, the volatility of earnings growth, and such like that. So that's a big input, but that doesn't tell us when to buy a stock or when to sell a stock. Technical analysis tells us when to buy it or when to sell it. What fundamental analysis does is help us build candidate lists, stocks that we want to own, and then when price tells us it's time to own the stock,
Yep.
we will. So we call that rational analysis, and I think it's really, really important. So, that's in a nutshell, that's the crux of our capital management process.
Nice.
The idea that, you can combine these tools in a way that's more powerful than any of the tools singly, I think is really, really important. There's a synergy there
Yeah.
that really works.
Yeah. Well, it's very similar to what I do here. And
No, I understand.
Yeah, very similar because I call it fusion analysis.
Yeah.
But it's the same way. And of
Oh,
course,
let's fight about that. It's rational analysis.
so because, well, it's fusion because
No, it's rational.
Yeah. It's fusion because I put sentiment indicators inside this bunch of indicators.
So it's really funny. So in the beginning, there was only technical analysis because there was no fundamental data for people to use.
Yeah.
Right. So if you go back 150 years, there was nothing other than technical analysis. You looked at price over time and bought or sold based on that.
Yeah.
You might be able, as an analyst, to go out and visit one company or two companies or three companies.
Yep.
But that's what you could manage, and especially if companies were not near you.
Yep.
Then you were really so. As time went along, fundamental analysis became possible as companies started to publish annual reports on a regular basis, and you could get data, reasonable data about companies. So you could do so. Then by the 1930s or so, there was actually two analytical camps, technical and fundamental.
Right.
Then as we come into the 1960s or so, we meet computer power.
Yep.
Right.
And the average.
And that's the birth of quantitative analysis. So the quants looked over and they took the best ideas from fundamental analysis. They took the best ideas from technical analysis. They combined them into quantitative analysis in a rigorous mathematical way.
Yes.
So now we have three camps, right? You got fundamental, technical, and quantitative. Meanwhile, from about the 30s or so with Humphrey Neal, we start with this behavioral finance idea. They called it sentiment analysis and such. And so by the 80s or so, the academy, the universities are starting to pick up on these ideas of how investors behave over time. And they give birth to the fourth piece of this. That's behavioral analysis.
Yeah.
So today we got four pieces instead of two pieces.
Yes.
And they're all good. They're all useful. There's valuable information in all of them. It's just up to you to pick which parts and pieces you want to use and put them into your toolbox.
Yeah, this is present and future because we can combine everything with the machine and that's running our trade system.
And now you can build your own little AI engine, right? Because a lot of the AI software is actually open source, so you can download it onto a server and build your own and start feeding it these inputs from these different disciplines that you like and have it do the sorting and prep work for you so that you're there for the final decision process.
Yeah,
but again, you have to understand how that works, because if you do it in a blind way, then in come time of stress, you're going to be in trouble.
Yep, definitely. Yeah. So when I started with the stock market, it was 2002. I was very young at that time. I was working on another brokerage firm, and on that time, there was a lot of battle between technicians and fundamentals.
Stupid.
Completely. Completely.
Why battle? I mean, come on.
Yeah, but now I think it's past. Okay, they recognize each other. Nowadays, we don't have this problem anymore. But we still have debate here that I really would like to hear from you. Is that possible to time the market?
Oh, it's absolutely possible to time the market.
Because most of fundamentals don't believe in on that.
Well, most of the academy doesn't believe it either, and they publish these papers that show that they've tested timing the market and failed. All they've done is prove that that person can't time the market. That doesn't mean that nobody can time the market, right? It only means that they failed to produce a result that was acceptable. Mm-hmm. So, there's no need for this debate. Of course the market can be timed. It depends on what you're trying to achieve.
Mm-hmm.
There's undoubtedly times when there's excess risk, when there are real systemic problems, and that you should be out of the market. That's market timing. That's the great financial crisis, 2006, 7, 8, 9, right?
Yeah.
So, this idea that you can't time the market, it's mad. It's actually mad.
Yeah.
All it means is that, some people have tried and failed, but that doesn't mean that you can't try and succeed.
Yeah. Yeah. So just the message is sit down and study. If you can't do this, let the other people do it, but do not interrupt me. Do not say things that you just can't do.
Exactly. I mean, I've been in this business a long time now, and plenty of people have told me that I'm mad. However, I've been quite successful while being mad.
Definitely. So, John, let's talk about Zoe, your daughter. So as far as I know, she's working with you, with the firm. So how is that working with your kid, your child? And how did she came into this business?
So my daughter went to university and studied international service and had a quite successful career in international business development. But about 7 years ago, it came time for her to make a change. And she wasn't really sure. There were several firms that wanted her to join them. And she wasn't really sure about it. And she'd never shown any interest in our business.
Oh, really?
No. She just she figured that was what I did, and that was fine, and it just wasn't of interest to her.
Oh.
And so she looked over and she realized that I was probably going to retire soon. And she realized that it was sort of, if she was going to give it a try, it was sort of the last opportunity. So she decided to come work for us. And, I answered about 10,000 questions the first year.
Wow.
And the second year, I probably answered about 20,000 questions. And the third year, even more.
Wow.
But it just fit in. She really likes working with our customers.
Nice.
She really, our clients, she really likes the interactive and the planning aspect of it. And that was the hook for her. And then she got interested in system development and the portfolio management side of the business.
Nice.
And then she just took off. I mean, it's just been incredible to see.
She learned from the best.
She become a very strong analyst. She's a great systems developer now. In fact, here's a funny anecdote for you. We just launched maybe 4 months ago, a new system that she developed, and it holds a relatively concentrated portfolio, just 20 stocks, and it's based on a relative strength formulation that we came up with. And one of the stocks in that portfolio is XP.
Oh, really?
Yeah.
Wow, amazing. So we have an opportunity here, guys. Unbelievable. Wow.
So it's just been incredible. I know people say that it's really hard working with your family. but I've not found that to be the case.
Okay.
I go out of my way to pay attention to what she says and not to tell her what to do, and to treat her as a partner in what we are doing and the decisions we make.
Wow.
And that has worked.
Nice. So, well, the next year, maybe we can bring Zoe to Brazil to explain her process, her ideas, and everything that she does in the capital management.
She would love to be here.
Yeah.
Love to be here. She did that international business development for a long time, and she loves to travel.
Wow. And actually, with the charts, we can do whatever, we can trade from whatever place that we...
That's the magic. Now, I'm here in Brazil. I checked my portfolios this morning. Yesterday we had a couple trades that we had to make. Easy peasy. I mean, it's just,
Nice.
It's incredible. The ability to log on to our systems remotely in a secure manner, have access to all of our resources on the road, just unbelievable.
Nice.
That, and coupled with the power of these mobile phones today, that
Yep.
the connectivity that they offer and such like that, never have to be out of touch, never have to worry about not years ago when in the bad old days, I was in Australia, getting up in the middle of the night and putting coins in a payphone.
Oh my God. Oh God.
And asking an operator to get me an international line to
Wow.
to my office.
So,
So much has changed. So much easier now.
yes, so much data, available.
And the old bad old days, we kept charts by hand and such like that, which was really useful because it kept us really in touch. But it also consumed a lot of time. These modern charting platforms like TrendSpider and TradingView and such like that, they've they make it much easier to do all of that. So we have a lot more free time to do research and to spend on making decisions rather than doing the labor of this business.
Yes. And what do you see about the future in this industry, technical analysis industry? What do you see? What can you expect?
Just going to continue growing. I mean, look at this place. We're around there. There are thousands of people here, right?
Yep.
Many of them interested in technical analysis. Many of them interested in short-term trading. Many more interested in intermediate and longer-term trading. This sort of event was unimaginable some years ago.
Yeah.
So I see nothing but growth for both investing in general, for the in all the disciplines, whether it's quantitative, behavioral, technical, fundamental. I think all these disciplines are going to grow. And I think that the interdisciplinary process, whether you call it fusion or I call it rational analysis, it's rational analysis.
So, Joe,
it's going to continue to grow.
Yes,
and
definitely.
it's going to provide really powerful tools for advisors like myself to aid our clients in achieving their goals.
Yes, definitely. So we are almost there for our time here, but I must ask, so what do you see, what is your analysis for stock, for S&P 500 right now? So what do you see in US markets, this whole thing, tariffs and volatility, a lot of things going on that?
Well, as we speak, the S&P 500 is trading in new high territory,
Yes.
literally today.
Yes. Yeah.
The NASDAQ, the 100 as well, and the smaller cap indices, like the S&P 400 and 600 mid cap and small cap indices, are very close to achieving new highs as well. So it's a very strong market. We talked about breadth indicators before. It's actually the breadth is expanding. The number of stocks participating is expanding. It's not great yet, right? There's still some worries. We don't want to see more new yearly highs. That would be really important.
Yep.
Not seeing enough of them right now. We'd like to see, some of these breadth indicators a bit stronger, but you can't deny price. Price is going up. We're walking up the upper Bollinger Band in terms of the S&P 500. It have been for some time. So what that says to me is that the craziness in the news is just the craziness in the news. You have to remember that the stock market is the best economic forecasting tool we have.
Yes, definitely.
Hands down. There's nothing even close in terms of effectiveness of forecasting the economy. And the stock market is not forecasting a recession. It's forecasting economic growth. So I think that the growth engine in the U.S. is actually strong enough to overcome all this madness with tariffs. I hate tariffs, right? I'm a free trade kind of guy. I just am. But the stock market is arguing very strongly that the tariffs are an annoyance, not a deterrence.
Yes.
So we'll see. There's no question that some countries took advantage of the U.S. in terms of managed trade and certain kinds of trade tactics. And that a lot of people in the U.S. Feel justified a bit in pushing back. I wish that weren't so. I wish trade were fairer and flatter across the board, because that way we all can gain advantage. All countries can gain advantage from each other in a mutual sort of way. This doesn't have to be an adversarial process. It can be a mutual process.
Yeah, definitely.
So anyway, the stock market's telling us that the economy's pretty strong, and
the breadth is strong.
Who am I to argue with?
Yes.
Here too, yeah?
Yeah, definitely. Yeah, we are about, I think it's 6 or 5% close to the higher highs.
Yeah.
So we are almost there, especially with our interest rates going down. Stock markets, boost, can rally again.
Yeah, we don't have the benefit of interest rates going down in the U.S., but we do have the benefit of, good, strong economic activity. Yeah. I saw a chart today, earlier, a friend sent it to me. It showed that business and commercial loans are starting to expand. Well, that's a very powerful factor for the economy. If they would we talked about divergences before with breadth data. This is the same sort of thing. If these loans and banking activity were starting to contract, we'd worry about stocks, right? But they're not. They're expanding.
Yeah. They say that the stock markets are going up is a strong breadth because of the microeconomic, because of the earnings, especially for the top 10 and Max 7.
Yeah, I'd agree with that.
Yeah, that's why. So they are just following the profit. They're just following the earnings revision. It's still, a lot of capex going on over there. They expect a lot of profits.
So here's something for your listeners to think about. So, NVIDIA, everybody knows about NVIDIA.
Yes.
It's not the strongest tech stock.
Which one? What is it?
I'm not saying.
But you're long, definitely.
I are.
Okay, let's find out.
But this is the thing. This is what we were talking about, paying attention, right? NVIDIA is doing really well, right? But there are other tech stocks that are doing better, right? So wouldn't you want to take a look at those as well? So I understand everybody thinks that it's a market of only 7 stocks or 10 stocks or whatever, but that's simply not true. There's a ton of other opportunities in the stock market, and all you have to do is pay attention and look around. So,
nice.
I remember I apprenticed in the beginning of my career. I apprenticed for a year to a trader to learn the business. No money, no nothing. I just came into the office for a year. I kept his charts by hand, and I kept his indicators by hand every day. And I watched him trade, and I learned. And when I left, he had some advice for me. He said, pick a system, any system, and use it. right? And that's really important. Pick a discipline, any discipline, and use it in a disciplined way. And so I asked him, I just had this flash. I said, how about just buying the new highs list? And he looked at me and said, that'll work.
Yeah. Yeah. Yeah.
Right?
Yeah, definitely.
So why don't you read the new highs list every day?
Yeah.
Look for ideas.
Yeah, of course. So, John,
I mean, you want to own stocks that are going up, right?
yeah, of course. Yeah.
And the opposite. If you like the short side and you like that, read the new lows list. See what's breaking down. See, if a stock's going to go to zero, it's got to start on the new lows list.
Yes.
If a stock's going to go to the moon, it's got to start on the new highs list.
Yeah. That's the benefit of technical analysis, that you can choose. You have a lot of opportunities of many ways that you can see the markets and act on it.
Yeah.
Yeah.
So it's really a couple of things that I want to say. It's really important. It's a privilege to be in this business.
Oh.
It's a genuine privilege to be in this business.
Thank you.
So, you should never, ever do anything that will prevent you from coming back tomorrow and being in this business. So whether that's using too much leverage or doing something that's unethical or illegal or any of the rest of that, it's literally a privilege to be in this business. So be disciplined and always leave yourself in a position so you can come back tomorrow and try again.
Yeah. Yeah. Stay alive. Yeah.
Stay alive.
Stay alive. Yeah. You don't get out the markets, because if the party's over, that's it.
They even have a song like that. The Bee Gees did a song, "Staying Alive," right? Yeah. Staying alive, staying alive. There you go.
So, Joe, what a privilege to have you here on Expert and person.
It's my privilege, and I really thank you for inviting me. It's a great joy.
Thank you very much. So we're about to finish here, so I leave you for the final message, maybe for Brazilians, for everybody. What is your final message? You can say whatever you want to say.
Be disciplined and enjoy yourself.
Yeah.
Life's short. Have fun. Be disciplined. Make money.
That's it. Thank you, John. I hope to you come back here. Not 20 years later, maybe next year. For those who are watching us, John was here in 2005 for the first time.
Yeah.
So 20 years later, he is here. Actually, we have a picture. So we will put a picture that John, Zoe, his daughter, was here, and Dorit, his wife. So what an incredible event that we have.
Last time she was a little girl. This time she was a full-grown analyst, right?
Yeah, definitely. Thank God. So thank you, Joe. I hope to come back here many times as you want. Thank you for being here.
It's my pleasure, Rafi. And I have one request. That before I go home, you teach me the Rafi indicator.
Of course, definitely. We are going to sit there and we will battle. And of course, I will teach my indicator.
maybe you will battle, but perhaps not me.
Okay. Okay, John. Bye-bye. Bye-bye, you all. Thank you very much.
Take care.
Ciao.
Ciao.